Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Jun-sok, professor of economics at the Catholic University of Korea. Professor Yang, good afternoon. Thank you for making time today.
Happy to be here.
Well, the U.S. Federal Reserve has released the minutes of its latest meeting, and they show that Fed officials are concerned about inflation, and if it persists at this level, then they'll have to raise rates faster than expected. That sentiment perhaps not a major surprise. Tell us, Professor, what you see in the latest Fed minutes.
Okay, well, the primary importance to stock investors, plans for the Fed are not yet set, but most likely the Fed will just carry out the plans that it has already announced. That has calmed down the market somewhat. So the rates are still likely to begin in March, even though some of the arguments in the minutes said that perhaps they should accelerate the tightening process. The end of bond purchases, the end of quantitative easing is still set for March, and reducing the Fed's balance sheet. In other words, quantitative tightening is still set for December, but how to do it, whether the Fed will sell off some of the bonds or just let the maturities of the bonds lapse, that is not yet set. But if the sales are warranted, sales of those bonds, then it will be far in the future. So again, while there were some argument for acceleration of the tightening process, that did not form the majority. So right now, the best projection for what the Fed will do is they will just carry out the plans which they have already mentioned. So that did a lot to calm down the market. Now, additional factors. Inflation is running faster than what the Fed has anticipated, but the FOMC members still expect the high inflation to be transitory rather than permanent. Omicron variant is making the situation more difficult, but economy and labor markets are still expected to be strong. So again, no big surprises, and it calmed down the market because Fed's minutes show that what's the discussion that's going within the Fed is not as serious or does not depend on more serious tightening policies than they expect already. This is not in the minutes, but the latest U.S. retail sales do show that the numbers are strong, and there is no signs that the inflation is slowing down the spending. So that may also have calmed down the market somewhat.
Well, as you say, kind of short on specifics in the Fed minutes, but there are growing expectations and growing calls that for the Fed to raise rates by 0.5 percentage point next month instead of the more usual 0.25 percentage point. At the same time, that's seen by some as a potential risk to growth. What do you see happening there? If we could talk a little more specifically, more moderate approach or more aggressive?
Okay, well, it will definitely be more aggressive than what Fed laid out at the end of last year. At the end of last year, when we saw the dot chart, the average rate that the Fed members expected was 0.75 percentage points throughout 2022, and I don't think anybody really count on that anymore. In January, we had the American Economic Association meeting, and many notable economists remarked that interest rates should be, not necessarily will be, but should be between 2 to 4% by the end of the year. So now the Wall Street analysts are expecting the rates to rise as much as 7 times in the year. I personally think that's a bit more excessive, but still, a lot of investment banks are mentioning that the rates may rise by 7 times throughout the year. And the speculation that the first rate increase may be 0.5 percentage point was started by remarks by St. Louis Fed President Jim Bullard, saying that he thinks the policy rates may go up to 1.0% by July 1st, which would make at least 0.5 percentage point rise necessary if the rates are going to go up by that amount. But the Fed and President Bullard is now taking back that remark, saying that nothing is set, even though the Bullard is still saying that the rate increases should be front-loaded this year. And previously, the Fed has stated that it would like to raise the rates by 0.25 percentage points, nothing to shock the market. So that's probably the best bet going in so far. They may raise the rates more often than planned, but they will raise it by 0.25 percentage points. As I mentioned in the last question, the Fed is still expecting the inflation to be transitory, and I think the important point is that the public also expects the inflation to be transitory. There hasn't been a there hasn't been a rise in long-term inflationary expectations. The latest University of Michigan Consumer Survey said that inflation expectation for 2022 is high at 5%. But over 5 years, public only expects the inflation to be on average 3.1%. So the inflationary expectations are still fairly transitory. And if you look at January's inflation rate for the United States, 7.5%, nearly half of that can be accounted for just by gasoline, fuel oil, and used cars. So while inflation is going up everywhere, it looks worse, perhaps worse than it is, because some goods, gasoline and used cars, are going up by more than 40%. But in the short run, these items may go up even more because, well, for gasoline, we have the problem in Ukraine, and for used cars, we have problems in Canada, notably the truckers' protest in Ottawa, which is preventing auto parts from coming into the United States from Canada. So at least in the short run, next month, we may see the prices of gasoline and used cars rise even higher, pushing the CPI inflation even higher.
Well, looking at Wall Street now, the Fed minutes did seem to ease some uncertainty in the short term, but then there are the tensions over Ukraine. As you mentioned, the market rallied toward the end of the session. The Dow and the NASDAQ closing slightly lower, but the S&P with a modest gain. What's the story in the global equity markets? Okay,
well, the U.S. markets did fairly well this week, partially, especially on Monday, because there has been some reports claimed by Russia that they were lowering the numbers of soldiers at the Ukraine borders, but with such withdrawal has not been confirmed by U.S. or NATO. So on Tuesday, the markets seem to have been very nervous. And once the minutes were published, because things did not seem as worse as they expected, the markets did pick up. But still, the markets seem to be very nervous, and the European markets ended before the FOMC minutes were announced, and DAX, FTSE, and CAC all fell between 0.07 to 0.28%. For Asia, things were doing very well in the morning, but then in the afternoon, things fell apart because around 1 p.m. Korea time, there were news about Ukraine forces shooting at pro-Russia separatists in eastern Ukraine, and that seemed to have just dampened the Asian markets. So Nikkei, Hang Seng, and Shanghai all are down to varying degrees.
Yeah, as you say, here in Korea, we did see a gain on the Kospi, a decline of similar size on the Kosdaq, and as you mentioned, both indices had been rising steadily in the morning and then plunged around midday on that news. The Kospi, fairly strong buying by foreign investors. Tell us about the domestic market.
Okay, so as with the other Asian markets, it did very well until 1 p.m., but once that news was announced, the market just took the news very badly. It did try to go up during the rest of the day. Kospi recovered and gained in the plus. Kosdaq did not. So Kospi ended today at 2,770.66, and it gained. It went as high as 2,770.66, but it fell and it ended at 2,744.09. It was up 0.53%. Kosdaq, it went up as high as 890.78 before falling, and it ended 874.26. It was down 0.44%. But the interesting thing about the Ukraine news is that the Ukraine government has denied that they have attacked the separatists, And other than the Russian press and Reuters, other news agencies such as the CNN and BBC have not really picked up on the news. So there's a question on whether that attack really took place.
That's a great point, and we're going to continue to follow that story. Professor, thank you as always for sharing your insights with us. We appreciate it.
Thank you.